Dividend stocks and covered calls go together like peanut butter and jelly. With dividends, you're getting paid to hold a stock. There are a couple different strategies with these. Some people like to focus on tech stocks that pay meager dividends, but also tend to grow faster. Other people like more settled, classic dividend aristocrat stocks for very steady returns. And some people aim for high-yield dividend stocks and take on the risk that is associated with them. What I really love is finding companies that I see solid leadership and a long-term future in, especially dividend aristocrats. Holding them for the dividends and then selling covered calls can get you more value out of holding. If you're unfamiliar with covered call writing, calls are options contracts that give you the right to buy typically 100 shares of a stock at a specific price, called the strike price. Options are time-based, so an example of a call, let's say SPY, could be something like SPY 320, July 10th, 2020. That's a price, a date, and a ticker symbol. To get an options contract, you need to buy it from someone who writes it. This is what selling options is. The cost of the contract is called premium. So if you sell an option, you get paid, and because it costs money to obtain one, it doesn't really make sense to execute the option most of the time unless it's in the money. Going back to our example of SPY 320 July 10th option, if we bought it and SPY goes to say 325, we could execute it and buy 100 shares for $5 cheaper than what they're currently trading at. If it doesn't reach that high, then the option expires worthless and the person who sold it just gets to keep the premium without any consequence. Because options are very cheap compared to 100 shares of a stock, and they give you control over 100 shares, they often are used to hedge bets, and you can extract money fairly consistently from hedgers or people praying for extreme shifts in the market. If we take a look at some of these SPY options, we can see some are trading for a ridiculous amount of money. And as you get farther out to more and more extreme values and time frames, they get cheaper and cheaper. The more likely something is to happen, the more it's going to be worth. If you own 100 shares of a stock, you can safely sell a call on them. This is because if the strike price is met, you simply sell your shares at the strike price. If you sold a naked call, a call without owning the underlying security, you theoretically have infinite risk because you would have to go to the open market and buy 100 shares if it's in the money, and the stock could go infinitely upward in price. So if you're holding a lot of dividend stocks, you can sell covered calls on those stocks and collect premium as well as a dividend. The catch is, if your strike price is hit at the time of expiration, it's almost guaranteed you'll lose your shares. If it gets very close right before the ex-dividend date, there's a possibility of early execution with an American-style option. But other than that exception, typically early executions almost never happen. Now, if you're in love with the stock and you'll lose sleep at the thought of it leaving your portfolio, then you shouldn't sell covered calls on it. Personally, I have a few stocks that I got for cheap, and I'm selling deep out of the money calls on them and collecting premium. US Bank is one that I've been doing a lot of. I love this stock because US Bank has good cash reserves, fantastic track record, was infamous for being a conservative lender, especially with credit cards, and they have over 4% dividend yield currently. Not to mention the per share price makes them very approachable for investors who don't have a whole lot of money to work with. With 100 shares, you could earn $42 a quarter, assuming things stay consistent. That's $168 a year. Not bad for something where you literally don't do anything but hold. However, let's take a look at their options chains. It's Thursday, so it's hard to get a good look at the weekly options, but a deep out-of-the-money option each week can net you $14 or more. Let's open up July 2nd. We can see that around $43, $42.50, you're still earning $14.12. Let's be very conservative and say you can consistently do a $10 out of the money option. They're just over 52 weeks in a year. And let's say you only sell on 45 of those weeks. Again, a very conservative calculation here. That's $450 a year. Think about that. Assuming this stock does not go up in price at all, you're making over 2.6 times the money you would with the dividend. And the dividend is assuming a 4.42% dividend yield with no uptake in share prices. 4.42 is a very, very solid dividend yield. That should show you just how powerful covered calls are. Remember, we're very conservative with our calculations. I would not be surprised if you could squeeze out $550 off calls alone in a year. Now, this is with the assumption that your calls are never executed. There's a risk, but you put your calls at a strike price above what you bought. Even if they aren't executed, you aren't losing money. However, you can cap your max profit if the stock goes a lot higher than the strike price. Always a risk, and it's up for you to determine if you think that risk is worth it. For me, absolutely. I've been using covered calls for a while, and I think they're a great way to squeeze a lot of money out of a stock that you want to hold. I like weekly options because time decay on the price of them is strong, and I can change my strike price per week to move with the stock. Super useful if you think the stock is going to go up over the long term. Covered calls are an incredible tool. I'm a huge fan of them. Just realize you're introducing more risk for more profit. But when you consider the maximum risk, your call being executed, it's not too bad. You just sell at a price way higher, unless you bought really high and you're selling covered calls at a price lower than what you bought at in the hopes to try to make things up. Again, it's always going to come down to how you view the risk. Personally, I've had a lot of success with them, and I think you can bury pretty safe prices and just squeeze out money consistently without major risk of huge losses. Your biggest issue would really be that associated with holding the stock if it goes down crazy low in value and never recovers. And that's with holding any security. So that's really why I love covered calls so much, and they really are a great supplement to dividend stocks, in my opinion.